a fever pattern broke today. The VIX coughed up 4.78 percentage points as liquidity returned to engineered sectors rather than defensive hedges. Capital is choosing selective exposure over blanket coverage after a month of uncertainty. The question isn't whether recovery continues, but who survives without new infection. The data shows the market running hot in specific zones while cooling elsewhere. Speculative leaders arc climbed 72% as thematic investors rotated into energy and healthcare themes after midweek corrections. SPHB, our health sector ETF, surged 67% following biotech earnings that beat expectations despite macro headwinds. However, broader consumer discretionary slipped 1.31%, suggesting retail confidence remains fragile. The same consumer base that fueled last month's rally is showing signs of fatigue. Our metrics confirm credit conditions are stabilizing but not yet healing. The Russell 2000 gained 0.61%, while IWM matched at 0.55%, indicating small cap liquidity returning faster than large caps, a classic early recovery signal. Meanwhile, the Dow Jones dipped 0.04% as industrial cyclicals lagged. This divergence mirrors the earnings calendar. Tech and healthcare reported strong Q2 guidance, but industrials still face inventory overhangs from last year's boom cycle. The pulse is recovering unevenly. Fear metrics are flatlining after yesterday's spike. Shed 4.42% as implied volatility collapsed from record highs. This isn't complacency, it's recalibration. When the VIX drops nearly 5 points in a single session, it signals institutions are hedging against downside rather than expecting upside. The correlation between fear and sector performance confirms this. Defensive sectors like utilities XLP climbed 0.41%, while cyclical plays underperformed. We're seeing portfolio insurance being purchased selectively. Exactly what happens before the next leg down. The underlying economy is showing bifurcated strength that mirrors the market's mixed performance. Service sector data, implied by high rising 0.09%, suggests wage growth remains sticky even as manufacturing slows. Consumer spending, tracked through HYGW's 1.19% gain in high-yield bonds, shows resilience but diminishing returns on new debt. The real economy isn't recovering uniformly, it's adapting. Service businesses are absorbing inflation, while traditional cyclicals struggle with margin compression from elevated input costs. Safety assets are being deployed differently than last month. Gold GLD gained 0.99% without bond yields providing the usual tailwind. This is currency-driven demand, not rate-sensitive positioning. TLT dipped 0.12% despite stable rates, indicating duration risk remains priced in even as credit spreads narrow. The safety trade today isn't about flight to quality. It's about hedging against asymmetric downside from geopolitical escalation or earnings misses. Investors are buying insurance selectively rather than holding full coverage. The hero, your portfolio, is being tested by a new villain, selective exposure risk in an uneven recovery. Tech and healthcare are the front line, showing strength while consumer discretionary and industrials absorb residual weakness from inventory cycles and margin pressure. The VIX's 4.78-point drop signals fear is receding, but not evaporating. This is tactical relief, not strategic confidence. Protect your portfolio by rotating into earnings-driven sectors, like biotech and energy services, while maintaining selective defensive positioning. The market is recovering its fever, but the infection hasn't fully cleared. The data indicates we're past the acute phase of volatility compression, entering a recovery plateau where sector selection matters more than broad exposure. Smotter Tech earnings releases next week. They'll determine whether this bounce extends into trend or reverts to range-bound behavior. Stay sharp but selective. The Canary is watching for the next fever spike.